Podcast. It's Friday, February the 21st. The first quarter is running away with us, and we are trying to keep up with all the headlines in the world, and of course, many of them impacting energy markets. So I'm delighted to be joined today to try and unpick some of those by Dr. Iman Nasri, MD of Middle East FGE Dubai, Rustin Edwards, Head of Sales and Marketing at TARS International, and Paul Horsnell, Head of Commodity Research at Standard Chartered Bank. Thanks, gentlemen, for joining us today. Paul, let me go to you first, and let's have a little bit of an overview from you on how commodities are doing, including oil. But in the context of the macro picture that we're looking at unfolding in the first quarter of this year, China being one of those primary players for commodities and oil imports, what do you think the view is as we sort of make our way through the first quarter? Is it bullish or bearish for oil and commodities?
Yeah, I think to start with, the year's been pretty robust for commodities as a whole, and the Beacon index has been hitting new all-time highs, hit another one over the course of the past week. So generally for the commodities complex, it's been positive. I think within that, there's a whole series of other sub-stories, obviously metals, base metals responding to some of the China data and the China outlook. Gold and precious metals following a path to, in gold's case, to further all-time highs given the overall geopolitical context and strong central bank buying. But I think we're looking at oil. And the first month of the Trump presidency, oil's behaved, I'd say, defensively. You can see risk is leaving the market. Volatility is falling. You would think of all that's happened over the past month, volatility should be high and rising. It's actually low and falling, very low levels of volatility. I think there's perhaps a reluctance from traders to sort of engage in any narrative, be it bullish or bearish, simply because of the concern that there have been other social media posts and the market could move $2 in either direction on whatever plan has just come out of the White House. So it feels slightly unreal at the moment. It hasn't really processed through, but I think overall you'd say, given all the news flow that's been thrown at the oil market over the past month in particular, for Brent to be holding in the high 70s and feeling like a bullish market trying to get out of this, that's actually a fairly strong performance. The fundamentals, they're fine. I mean, the demands, I think, exceeded expectations. The overall balance is good. There's absolutely no sign whatsoever of these huge, great surpluses at the start of the year and through the year, remember, which were dominating discussions at the end of it. Just not there, just isn't happening. And I think within that, that's keeping at least the price supported on the downside, but with that, big proviso that there's obviously an awful lot of event risk here in both directions. But up to now, I think it's so far so good for commodities this year. It's pretty robust and pretty resilient in the face of some fairly large objects moving around geopolitically and economically.
Well, interesting that you should say that volatility is down, whereas the feeling is that we're in a very volatile headline period and that, markets would be reacting more to that. But that's interesting, Paul. Thanks. And a kind of a positive, bullish outlook there. Iman, let me go to you on that. I mean, Paul just mentioned that this oversupply sentiment or fundamentals just isn't there anymore. Of course, we've got OPEC plus planning to start increasing incrementally at the beginning of April, but a lot of market participants saying that's just going to be too risky for them to do, regardless of what's appearing, that they're going to wait another 3 months. What's your view on that? Do you think they're going to proceed in April no matter what?
Well, yes, I think they're going to proceed with the plan in April, no matter what. That is an easy question to answer for me. But whether they will continue all the way until, let's say, third or fourth quarter 2026, that I don't think so. When they stop is a question that to answer depends on how things evolve in between. But to me, it's quite certain that they will not be able to finish it, and they have to change the course of action through either putting a pause at some point, maybe 1, 2, 3 month or a couple of quarters into it, or until end of 2025, I see them able to keep the market fairly balanced, maybe slight build, which is fine given where the stocks and inventories are versus the historical average. But going into 2026, they either need to keep it flat or even cut further, looking at the fundamentals next year as it stands with non-OPEC plus expected growth, as well as our anticipation. And yesterday I was at this conference in Dubai where we had a few other prominent market analysts and researchers presenting. Looks like the consensus is that 2026 is going to be perhaps even worse in terms of surplus. So I think they're going to unwind because, as we said last year, and they already missed one chance, one opportunity to get some barrels back in the market, and that's mainly to keep the spirit and the conformity of OPEC high, as opposed to anything else. The reality is that the non-OPEC plus growth has been capturing most of the demand. This year, we're expecting 1.3 million barrels per day of the demand, which is healthy, which is good. But the reality is that there's a lot of non-OPEC supply coming mostly from Atlantic Basin, and that's going to capture most of this. I think they're going to go ahead with it, especially in the face of many uncertainties that Paul mentioned on both positive and negative, and one of which is basically the Iranian barrels. That is a big question mark on how Trump wants to implement what he called the restoration of maximum pressure campaign. We're still waiting to hear from Department of State and Department of the Treasury how they want to implement that.
Yeah, thanks, Iman. Certainly, we're still waiting to hear on that front. They've been sort of busy announcing lots of other things, and that the Iran factor certainly hasn't been top of priority, at least publicly speaking. Thanks, Iman. Rustin, welcome back. Let's talk a bit about. I mean, Paul and Iman are giving slightly different viewpoints. I mean, would you concur with Paul in that we would actually? I mean, it is a good time for OPEC, isn't it, Iman, to start putting barrels, because the market's looking stronger, certainly, than it was 2 months ago, slightly more supported, so less risky for OPEC. But Rustin, from where you stand, and you're heading commercial sales for a company that's producing shale or fuels from shale in Estonia. So, but from a macro perspective, your impressions there, as you sit in Europe, on the demand outlook, if you like, and how positive that looks for the sort of quarter or two ahead.
Well, I mean, I think you've got fairly good demand. I mean, if you look at the way the market's been pricing, we've been pricing sideways for the better part of about 4 or 5 months now, and mainly because it is a factor that you've got the geopolitical risk of the world supplying a very good support mechanism, while the macroeconomics have been supplying the ceiling in the price action. And so we see, you see price action that happens throughout the week, and okay, we're going to have probably an up week this week, but nevertheless, we've still been trading between 72 and 80 bucks a barrel. The big trades, it looks like it's always on structure. That's where people are putting the risk premium in the market, in the expectation that there will be a headline that will cause a market spike at some point in time, which I think is the way the market has to look at things right now, especially with Trump in the White House, and we're one tweet away from a $5 move. That's either up or down, depending on how you want to play it. So, but nevertheless, when you look at it from a demand profile, I mean, from a consumer fuels standpoint, consumer fuels have been trending the same way they were trending last year. They've been kind of flat year on year now, but they're still not at pre-COVID levels, which hopefully I can start saying pre-COVID at some point here in the near future. Now that that's almost 5 years down the road, it's like we can finally wind that data off the table. But nevertheless, it just shows that there is a change in consumption and a change in demand profile, which is starting to roll through the markets. And I think this year, especially when you look at it from an Atlantic Basin standpoint and all the changes that are happening in the Atlantic Basin with new refining capacity coming online in Nigeria, in Congo, in Ghana, as well as all the new production that's coming online. I think we are going to end up in a market as we get into Q2 and Q3 where the dynamics in the Atlantic Basin are going to change dramatically. That is going to cause an upset on how we see the markets today and will require a big flip back to a different trading pattern. And that's irrespective of a release of sanctions on Russia, which will just throw another bit of ambiguity into how the market's going to react. So nevertheless, I think we'll see a weaker markets going into Q2 and Q3, just because from the demand side, supply side, there will be far more supply coming in that's going to be disruptive.
Okay, thanks, Rustin, for that. Paul, I mean, just talking about Russia, because of course it has dominated the headlines in the last week from a US point of view, the talks for Ukraine, and the likelihood of sanctions being lifted sooner, perhaps, rather than was expected by markets in general. And Russia is a big commodities player, obviously, and it's oil and gas. Do you think markets in general, commodities markets, are sort of waiting with bated breath? What difference will it make if sanctions are lifted, given that they have circumvented a lot of those sanctions in the last 2-3 years, more or less? Will it be a dramatic sort of impact, let's say, an overnight impact on markets if tomorrow sanctions are lifted?
Well, I think first point to make is that, I mean, we're certainly not on a path for sanctions being lifted tomorrow. I mean, there's talk that they might be talks about putting together a plan from, there's no inevitable plan there that leads to talk of sanctions relief straight away. But I think the key point I'll come on to gas, but I think the key point on oil is, whether there's whatever the time span is, or whether sanctions get lessened, and Europe is in no mood for taking off sanctions at the moment. No. That's and it's the European sanctions which really were the tightest ones. If anything, some of the US actions were aimed to diffuse the effects of the European sanctions. But even putting that aside, the question of sanctions does not release Russia from its OPEC plus obligations and promises. So they are producing where they should be now according to their OPEC plus promises. It doesn't really matter. They're not going to get an extra bonus allowance because they're no longer sanctioned. So in that sense, the question of how much Russian oil enters the market is the same question as we already asked in terms of the OPEC plus unwinding of the voluntary cuts. And I don't think it's relevant. I mean, I have seen articles suggesting that there will be a huge amount of new Russian oil that will move around into the European market, into Asia. Really don't think so. I think they will have to stay within their OPEC plus obligations. So for oil, less than meets the eye, but with that added warning that we're a very, very long way from lifting those sanctions. Remember, a lot of those sanctions go back a long way, and this didn't start with the invasion of eastern Ukraine. In 2022, it started the annexation of Crimea, the shooting down of the Malaysian Airlines plane over eastern Ukraine. There's quite a long pattern here before I think get on to relief. Yeah. On gas, very quickly, again, I don't think there's, while the European gas market did react quite badly to the rapprochement between the US and Russia, I think in the belief that it might free up Russian gas supplies to come back into Europe. I think when you actually look at where the pipelines are and where they're going, I don't really think there's going to be a large volume there. Germany is not likely to take supplies from Russia again. They see Russia as a totally unreliable supplier now. Why would you put yourself up for that?
They've learned that lesson. Yeah.
Poland, the Baltics, they won't take it. So the only sort of question then, could transit flows through Ukraine re-emerge? Depends what kind of Ukraine comes out of this, but I think at this stage probably unlikely. So you're then just left with the only way in for pipeline gas is Turkstream, and that's pretty much maxed out. So again, I don't think there's going to be a huge flood of Russian gas in, because even if you took sanctions off, people don't necessarily want to buy it.
Yeah. Okay. Thanks, Paul. As you said, the Europeans have to agree on that, and they have plenty of other things to be worried and thinking about as well at the moment, don't they? Iman, just back to you. Talking about gas, there's a headline bulletin today on our news bulletin on ADNOC Gas looking to partially IPO a portion of it, sell some shares. Can you give us your take on that in terms of, obviously seen some Gulf NOC outfits gradually do, not small IPOs, but of course not full sales. Why do you think that is now on the agenda for ADNOC?
To be honest with you, these 3-4%, or sometimes 1 to 2% in some of the other midstream and upstream assets that they've had, I wouldn't see it as a huge change in the strategy and policy. It's more of funding some of their other projects, and it's basically you keep your asset, you run it, you make all the decisions, you sell your services and products, and you get paid basically to fund some other projects. I only see that, and in line with overall UAE and in fact Saudi. So if you want to continue this investment from out of let's say fossil fuel or investment into other, you need to start funding those projects, and this is the only way. So again, I would not interpret it as any significance or significant change in direction. It's just another way to make some money for other projects. ADNOC also has a long list of projects at home, potentially has started to look into more foreign investment, and this is just one way for them to make more money.
Reorganizing their financing.
Yeah.
Rustin, let's talk a bit about, I just want you to put on your previous hat a little bit. I mean, talk about shipping, and just in terms of it from your perspective now, in terms of obviously being based in Europe, working with a company that is producing shale oil, but petchems is also a part of that as well. But just from that, we have an article today on our again on our news bulletin about Red Sea shipping, Suez Canal flows. Just from your perspective of having seen what happened last year, obviously, the incidents that we had, the rerouting of shipping for products and crude, are we seeing a back to normal sort of scenario emerge? And would you expect that, given that, the market is just not being rocked anymore by any of the geopolitical headlines, when will we see sort of normality, do you think, back on those routes, if we indeed are going to turn back?
Well, what's the length of a piece of string for normality? I mean, that's a. I mean, right now you don't see like a wholehearted release effort to go back to the Red Sea, mainly because again the Houthis are kind of holding all the cards close to their chest of how they're going to interpret what goes on between Israel and the Palestinian and Hamas. I mean, so they've always been aligned with the Hamas and the Hezbollah. And so as a case of are they going to pull back? I mean, they have made their own announcements that they'll pull back, but I don't think shipping companies are willing to take a risk to put a ship through that channel and to have it hit by a missile. Depends on where your ship's operating from or what's going on. But nevertheless, tankers and dry bulk are probably going to make the first runs, and I think some companies have already started to make that run. They're paying the higher insurance rates, putting on armed guards, what have you, as a protective measure. I think container ships are going to have a bit of a harder time to reroute everything, because once you've set up those supply chains for the box boats to go to all the different markets now that they've opened up with the new routing, to revert back to what they were doing before, it's a very large logistical effort, and you're going to lose and drop customers that got used to the new supply chain flow. So yes, you save 2 weeks in a voyage going through the Suez Canal versus going around Africa if you're going from Asia to Europe. But it's a high risk 2 weeks right now because a box boat fully loaded with containers is a pretty big target, where a tanker or a dry bulk ship has a very low profile compared to that of a container ship or a railroad carrier. So I don't think we'll see a wholehearted return as there was once before, but I think there'll be a gradual increase as people see how the Houthis react and how they interact with shipping going forward.
And that's all on hold, I guess, at the moment, in the sense of, as you said, it's all linked to how the geopolitical resolution unravels. And that's kind of obviously in a bit of a pause right now. We have a ceasefire, but very fragile. There's our survey question. Yep.
It's very fragile, but it's a Pandora's box. I mean, the Houthis opened up a Pandora's box of they can dictate terms to the world by shutting down the Straits of Bab el-Mandeb.
Yeah, yeah.
So
they haven't done that yet.
They haven't done it yet, but now they've proven they can do it.
Yeah, yeah. Well, they have that tool in their hand, I guess, but a lot of consequences would come from that as well, I suppose. There's our survey question. OPEC+ likely to postpone adding volumes until Q3 to allow time for the market volatility to settle. Iman saying no, that's not going to happen, and Paul saying we're not as volatile as we were even a month ago. So they may start, but then pace it. Paul, back to you. You mentioned China at the top of the hour. There seems to be a bit of more positive sentiment in the start of this year about how it's going to be continuing with its stimulus. That's, it experimented last year with different measures, and now perhaps it's in a better position to know what worked, what didn't work. Is that sort of what you'd be interpreting from what you're hearing, essentially, from demand point of view? Last year you would say a lot of people were disappointed by China by the end of the year, having had larger expectations. Are we having would we have a more moderate, predictable scenario for Chinese demand across all fronts, and how its economy is going to continue to recover?
Yeah, I think it depends on sort of what expectations people had for this year. And I think if there were concerns of the more extreme hard landing in the China economy, then that's what's receded. The sort of, again, those sort of tail ends where, be it property market or whatever, or a failure to put stimulus in would just lead to extremely poor economic outcomes. I think those risks have perhaps subsided, but still left with a scenario which, if you're expecting that wasn't going to happen, then the current data is what it was. I mean, it's okay. It's nothing particularly that's going to drive the whole of the oil market. We still think India is going to provide more incremental growth than China does this year. China also agree with him as 1.3 or 1.31. I think at the moment is where we are, and of that, China's growth for oil demand's less than 2%. I mean, it's a relatively slow year. So again, it depends what your perspective was. I think for those who are expecting a sort of stabilization and moderate growth, it's pretty much going to plan. If you were concerned about the major falling off, then it's much better than anticipated.
And
But
what
we
about
sort of switched
what
from
about
very weak to very
yeah?
strong.
And what about how it's responded to the US tariff scenario so far? Obviously, minimal response, measuring its response so far, but again, shown that it's ready to take some action, hasn't it? And is there more of that expected, depending, of course, on what US does next?
Well, it's measured and in line with what happened during the first Trump presidency, where, of course, we did play out that cycle of tariff escalations and then a negotiated de-escalation through. So I don't think there's anything different from the strategy the first time round. And I suppose the main one was the tariff on US LNG. But when you look into that market, that's actually not a bad one to tariff as part of a retaliation at this stage, because that was also one that was tariffed in the first Trump presidency before those tariffs were removed, and it's something which you'd think must be really important to both countries. China imports energy, Russia's US exports of energy must be really important, but actually it isn't. The US is the fifth largest source of China's LNG. China is the sixth largest market for US LNG. It's about 5-6% on both sides of the equation. So it's something that neither side is going to be too worried about it getting distorted by tariffs in the short run, but it's also sending a signal about the longer term. Because in the longer term, you would expect that the US would want to build that market share. And so it works very well. It doesn't distort very much in the short term, replays the previous set of tariffs, and sends a signal about the long run. So I think that's a very measured response and a very careful one, sending other signals. So far, it's a replay of Trump.
In terms of China, but of course the difference with Trump this time is that he's not just targeting China. He's talking tariffs left, right, and center, north, south, east, and west. We'll see what happens next there. Iman, I mean, sticking to China, but again, and back to sort of Iranian exports, we're waiting to see if these maximum pressure sanctions will come. We have an article today saying that just as looking at just February loadings, those were up 86% from January into China from Iran. What explains that? Do you think is that just a catch up with something that was sort of refilling the stocks, or why have we seen such a jump in February?
Those headlines, you have to really take a cautious approach and be a bit more diligent about what they are talking about. Sometimes people mix loadings from Iran with receiving and delivering to China. There is that trade is not a normal trade that you load and you sell 2 weeks, 4 weeks, and then unload. There is a lot of ship-to-ship transfer. There's a lot of weight at sea to get a slot or arrange all the deliveries, all the arrangements, all of the documentation. And yeah, there was I think what we tracked and we saw was a rather unimpacted loading from Iran side. But yeah, there was some backlog and weight and what people call it floating storage, although it's not necessarily floating storage. I call them oil at sea, and Iranian oil remains at sea a bit longer. In December and January, while the people were working around the Shandong port ban on the sanctions and SDN listed vessels, as well as fear of Trump's basically maximum pressure campaign. But now they are hitting basically the land. There have been terminals that have been arranged to receive those. So if you look at December, January, and February together, we still are seeing at around 1.4 million barrels per day of Iranian oil going to China. But yeah, there was a little bit of backlog, which is perhaps now getting more offloaded into Chinese ports.
And I mean, if we do see, just sticking with you, Iman, if we do see the maximum pressure sanctions come in and those exports somehow forced to whittle down to about, let's say, 300,000 or 400,000 from Iran, what will China do?
I don't think that's going to happen, Dayal. Last time it went down to 300, 400 KBD at its lowest, only because basically there was no arrangements, no network, no shipping in place, and that would have been still the minimum that can find a home there. But between 2018 and now, there are a lot of new ships added to this, new people who are trading this, and the only chance that Trump can bring that down to 400 KBD is if Chinese are on board, and part of a deal, U.S.-China trade deal, that is a Chinese imposed ban through quotas and whatnot. But I don't see that. But as I said, Trump's maximum pressure campaign is not going to do anything new, and we're going to see some fear factor keeping some players out of the market unless there are new tools, measures, and one that is very important has been enacted in the U.S. but not executed is an act called SHIP Act, which is a Stop Harboring Iranian Petroleum that targets terminals, ports, and refineries. That, if executed, could take maybe another 1 million barrels per day of Iranian 2.7, 2.8 million barrels of total oil imports. Remember, over 1 million barrels per day of products are also exported out of Iran.
Okay, well, that'll be interesting to see. But as you said, it could be part of a bigger, if it's going to happen, it has to be that China gets something back from the US, certainly very significant. Sure. Otherwise, they won't go there. There's the result 60-40, 60% saying they agree that will be postponed. Let's wait and see. Rustin, let's go back to you to wrap up. Give us your take on also, I mean, how is the European refining sector looking these days? I mean, that's a general question for you, but in the context perhaps of petchems and where that might be going as well, one area that your company is dealing with. You know, obviously the poor man of Europe is refining at the moment, isn't it? With many shutting down the last few years and the shift to Asia and Middle East. Where are we with that?
Well, I think you have a very challenging next couple of years for the European refining complex, and a lot of it has to do with the fact that you have higher inlaid cost versus where you had 2 years ago, i.e., you don't have Urals coming in as you had pre-invasion of Ukraine, so you have to source crude from other locations, and on top of that, you have new Atlantic Basin refining that's coming online that's going to upset the balances of a lot of these Northwest Europe refiners. The Dangote refinery, up running around 60% of its capacity, trying to get up to 100% according to the press release they put out last week. You've got the Sorrento refinery ramping up its runs as well, going from 40,000 to 140,000 barrels a day. You've got the Port Harcourt, the Warri, the Karounda refineries, all up and running in Nigeria, and they're increasing run rates as well. And so between just those refineries in the West African basin, you've got basically no place for Europe to put its excess supply that it produces. And so you do end up in a point where the refineries are going to feel a crunch at some point of not being able to find a place to put their product to market, which makes the U.S. East Coast kind of the battleground of how that market gets supplied versus its current supply chain. So nevertheless, I think you see a much tougher environment going forward.
Yeah.
And you couple that on top with all the new regulations that come into play with the increase of the emissions standards on the EU ETS for shipping, as well as the Fuel EU Maritime, which also adds extra cost to shipping. It just makes the total inlaid cost to run these refineries even higher.
Yeah.
And I think that's going to be felt more probably next year than this year, but this year will be the first hit. And you can't forget that, in the Mediterranean, come May 1st, you have the ECA zone that's coming into play, which is going to reduce emissions and increase consumptions of one fuel versus another fuel. And that's going to play havoc on what the refinery mixes are that come into the second half of 2025.
Okay, well, certainly, so challenging times for Europe, already challenging enough, but doesn't look like the next year or two is going to get any easier on that front. Rustin, thank you so much, Iman and Paul, for joining us this morning. Have a great weekend, everybody ahead, and we'll see you all soon. Thanks so much, everyone.
Thank you.
All the
Thank you.
best.
Bye-bye.